Hello, everybody. Welcome back. Yesterday, we made a code that took us through the logistic regression analysis code we wrote on all of the changes, the daily changes, or the periodic changes if you're using hourly, minutely, 30-minutely, whatever you want. So we ran a regression analysis on the intra-period changes as a percent. And my goal, again, was to allow us to conduct a training and test split to show us a difference between what overfitting looks like and an effective trading model looks like when we break into machine learning. And when I say I worked with this code, it was me and ChatGPT. I had a little bit of help. What I wanted to do was assess what the optimal shift would be. So I knew that I wanted to loop through generating this regression output over as many shifts as we could. So let's take a look at this code and I'll show you what I mean by that. So shift range has now gone from, it was originally just 1 and you could shift it 1 period ahead, or you could do 5 and you would shift it 5 periods ahead. But what I wanted to do was I wanted to test every single shift. So changing our target variable 120 different times to see which target variable was most effectively assessed by the information we feed the model. Now, what this is doing is based on the data we have, we are going to be fitting as best we can to the optimal time period. So what this could allow us to do is if we were looking at minutely data, if we set this to be 1 minute, and we test every single regression output on the volume change, close change, high change, low change, and even Bollinger Bands through 120 different shifted periods, what we should do is assess which area under the curve is optimal. And you remember the area under the curve is this chart we have here. And it assesses how effectively we are accurately guessing true positives and true negatives. When we have at this bottom line here all of the possible cutoff thresholds, and given whatever cutoff threshold we have the accuracy assessed by this orange line. And remember, this blue dashed line is just randomly guessing. We want to create as much separation as we can. So what I wanted to see was which shift or how far ahead we needed to look to optimize this area under the curve. And the way we did this was, I'll just run this code and I'll show you. What happens when we run everything and we are shifting every single different period through 1 to 20 periods. So 1 period shift, the area under the curve is 53 minutes. But if you shift it a little bit more, you get a wide variety of areas under the curve. And the optimal shift ends up being 100 minutes. So about a minute, an hour and 40 minutes. And what this would mean for me is if I was going to place a trade on the minutely time frame, what I would want to do is make sure the holding period of that, if I were only to use these technical indicators, like only volume change, close change, Bollinger Bands, so on and so forth, I would want to be holding my trade for 140 minutes, or an hour and 40 minutes, or 100 minutes. This is the you can see the optimal shift is 100. The distribution here is 0.7. What happens when we do hourly data? I think the hourly chart on the S&P 500 is really spectacular. So we'll take a look. Not really. Again, the area under the curve only results going up to 54 again, and we want to see something closer to 60. And I want to also take you through a couple really important details about this target variable setup. So when you set up the target variable, every single time you add that shifted target, you need to avoid autocorrelation. You remember from linear regression, one of the assumptions we needed to assess was that there was no autocorrelation going on when we conduct the regression analysis. The same applies from linear regression to logistic regression. And the way I avoided this was by shuffling everything. And that happens in the generate regression output. Yes, happens right here. So what we're going to be doing is every time we have our data set up completely, we shuffle all of the rows randomly. We keep the state fixed, so it's always using a random state of 42, but we're shuffling all of the columns together, so there's no autocorrelation between errors. This is okay because we're not setting up a trading strategy. But if we were to build a trading strategy on top of the technical indicators we have here, we would need to make sure that the data was aligned in a time series format or from oldest to newest. But now, because we're only interested in assessing the statistical significance and effectiveness of our variables that we're going to be using in a trading strategy later, we can shuffle this data safely and trust all of the outputs from this model. Now, this is really interesting to me. Look at the distribution of logistic predictions here. You remember they can range from 0 to 1. Now, here they range from 0.57 to 0.75, which is not good. What you already know is going to happen is if our cutoff is 0.5, these are just all going to be 1s. However, you can notice that at about 0.66, there's 2 different humps, which is awesome. It means that the model is trying to distinguish between trues and falses, and it's doing so effectively. It's not just creating a distribution that looks like a normal bell curve, as we've seen in other studies. Let's take a look at this one. You can see it's just a bell curve, and it does a really hard time distinguishing between true and false, and it ends up just scattering around the mean. This one, however, creates 2 separate lumps, which is what your goal is in classifying models, is finding separate classes. And you can see our optimal curve is still 0.54, which is a little better than the 0.51s and 0.52s we've seen, but not great. And yep, here's our confusion matrix with it just all 1s. Now, if our optimal cutoff is around 0.66, we can change that ourselves to see what happens to our confusion matrix. So we have it set off to be 0.5. Let's change that. Let's do 0.66 and then see if our confusion matrix looks a little bit better. It does, but still not great. You can see that when it guesses down, it's guessing down incorrectly much more often, twice as often, as when it guesses down incorrectly. So model's still not very effective, and this is shown by the area under the curve staying at 0.54. Before we modify the cutoff threshold to make our confusion matrix more beautiful, or to, I don't know the proper term for it, to fit our strategy more effectively to the data, we should make sure our area under the curve plot is better. And that's the reason I used area under the curve to optimize our shift. Now we know that our optimal shift on the hourly time frame for the S&P 500 when we use these specific technical indicators is about 96. Now, that would just mean I'm holding for 96 hours every time I take an hourly trade on the S&P 500 based on the information we're using. Let me shift this back to 0.5. 0.5. That's the best one, because we remember our sigmoid function and where that cutoff generally is. So what if we did Tesla? So we can do Tesla on the 1 minutely, and I'm sort of just going to be exploring and talking about it with you guys from this point forward, because this is the code I'm going to be posting for the regression changes. You can see that it's optimized around 60 to 65 hours, or 70 hours. So the best one here is at 66. The distribution of predictions is pretty much still one big lump, but we got a 0.56 area under the curve, which is a little bit better. Again, some down predictions, but the general consensus is that you're still better off just guessing up every time, because I'm going to plot this close price again so we see what we're looking at, and we can understand why we're getting those up and down predictions every time. And we'll add this plot and just return the subset. So when we run everything, we get an understanding of why we're getting that 1 or 0 generally. You can see that almost all of them are over 0.5, and that makes sense because our price action was generally going upwards. So we're not providing useful information, we're optimizing the shift, and the prices are still generally going up. Now, what if we also added our other technical indicators? So we add Bollinger Bands, MACD, HIST, RSI, and MFI. And we take our regression anything, MACD, MFI, Bollinger Bands, RSI, great. So we have it all. So let's take our MFI and MACD code, Control C, and paste that in here after Bollinger Bands. And then from rig anything again, we want to also add RSI. I'm just going to do add BB as well. And from reg anything, I need all of these technical indicators. C. Perfect. So we've got our global variables for everything. Look back. It's going to be 10,000, so maximum. And then we need to also add our technical indicators in our main function. So let's take these from our main function, RSI, Bollinger Bands, MACD, Control C, back to reg changes, update our main function. Perfect. So when we run everything, we're now looking at the MACD histogram, the money flow index, Bollinger Bands, the relative strength index, and this is the minutely shift for Tesla. We can get up to a 0.6 with all of the technical indicators and our minutely data. Relative strength index, something's going on with the overbought and oversold threshold. Let me look. Oh, there we go. It has to be 70. All right, and then, so we've got a good distribution of logistic predictions. This area under the curve looks great. Look at that separation, meaning when we have our cutoff thresholds ranging between 0 and 1, we're bouncing away from randomly guessing trues and falses, meaning we're actually getting some information on the minutely data frame about what can happen. Our confusion matrix is looking slightly better, even though our prices still, always go up more or less. If we look at this, we're starting to veer away from only guessing 1, which would be every single prediction being over 0.5. Sometimes they're slightly less than 5, so we can assess true falses and false positives and true negatives and false negatives and so on and so forth. This confusion matrix is beginning to become a bit more spread out. So what happens when we use the S&P 500 daily, SPY, and then we do 1 day with all of this information, open, high, low, close, change, MACD, relative strength index, and money flow index, everything. Prices generally go up, so that creates a bias. MACD histogram looks like this. The money flow index, Bollinger Bands, relative strength index. Our optimal look-ahead window for the S&P 500 daily trades are 108 days. So if you're trading on a daily time frame with only these technical indicators, you are best off making an assessment 108 days in the future. And what is, on average, what happens in 108 days? You guessed it, it generally goes up. Every single one of our predictions are going to be up. If we set the cutoff threshold to be 0.5, you're going to want to hold every single time. Because when we're shifting 108 days, no matter what happens to our variables, prices go up. So this is what it looks like when you have that 108-day trade going forward. I'm going to keep actually playing around. Let's do S&P 500 on the 1 minute. Okay, bit of a scatter, so the confusion matrix won't be biased. Bollinger Bands up to 0.62 when we hold for 83 minutes. So an hour and 23 minute trades is what we should be placing with these technical indicators based on the information we have. Almost always guessing up because our cutoff is here at 0.5, 0.61, meaning we're almost always just guessing up. And generally speaking, we were right 61% of the time we guessed up. And when we guessed down, we were wrong more often than we were right. So buying and holding once again wins, regardless of what our look-ahead window is. And then if we do Tesla, which is a bit more sporadic, on the 1 minutely with all of our information. The 0.62 distribution. Same general idea. What if we did VMC? 1 minute. Up to point at 95 minutes. So if you're taking an hour and a half long trades on VMC, you can get 0.63 area under the curve. And generally speaking, we're still mostly taking ups. When we guess down, we're wrong more often than we are right. What we want to see is, even if the majority of our guesses are up, when we guess down, we want this square here to be a greater number than this square here in our confusion matrix, because that means our false positives are exceeding our our false negatives are exceeding our true negatives, but our true positives are exceeding our false positives. So we still get a 63% area under the curve, which is better than guessing, but only because of how often prices go up on the minutely time frame. That's the most important part. Even if we encounter things like this where it's like, oh, well, that doesn't work at all. We just have to guess one every time, and you might as well just buy and hold over the course of our study. That's boring. Boring is better than poor, and you will be poor if you start trading without understanding what's going to happen beforehand. So going off of this, we're going to see if we can break this into a training and test split, even though we are using a pretty bad model with pretty bad information. The effective models that you want to use before making really good trading strategies, you need to do on your own. So if you think you've come up with a great trading strategy, I hope you use this framework as a way of building that. So I'm going to make myself bigger so I can talk to you more directly. Ugh. This is not a channel that is going to give you the trading strategy and the solution to all your problems. We're probably going to be encountering really bad results all the time. And I'm intentionally limiting us to some of the most popular technical indicators in the world, the relative strength index, the MACD histogram, you name it. But other ones, the Fibonacci, TFI, anything you want, that's only two I can name, but there are hundreds. And you might have a special one of your own that you like a lot. The goal of this is to allow you to make modifications and test the code yourself. So you can go through this same process of testing the strategy returns, testing a model, adding that trading indicator to the strategy, building a model on top of it, and verifying that it will work every single time. But what we're not going to be doing is just showing you a working model. First of all, because it's really close to impossible, and second of all, because that would be not very smart of me to do for free. I do have a working model. It's taken me several years to create, and I do keep that behind a paywall. Very sorry. But I do want to teach you how to test your own trading strategies if you're not interested in just following along with what I create. That makes sense to me. investing can be boring and trading can be really exciting, but you need to do it safely and smartly. And that is the objective of this channel. If you have your own insights, apply them to this framework and understand whether or not they are effective before losing a single dollar following them. Trading doesn't have to be this toxic, idiotic space of infinite quick riches, and this channel isn't going to provide you with those either. It will give you a more rounded, effective, data-backed, tried and true, correct approach to making money in the stock market if investing is boring to you. But it's not going to be the end-all be-all. Suddenly you understand it. So I hope that makes sense. I hope what I'm trying to provide for you is clear. We're going to be going forward with linear regression and logistic regression, machine learning structures in the next episode. But we're probably never going to find the sudden holy grail of, oh my gosh, we can actually create an effective trading strategy with these simple indicators, because it's not how the stock market works. I'm considering doing a whole episode on how the efficient market works and what is causing these technical indicators to always lag behind useful. But I think I'm probably just going to keep up this sort of content. So I hope the direction of this channel is clear and it's not disappointing to you like you hoped we were going to find a winning strategy together. But this is supposed to give you the tools necessary to come up with your own strategy. This is the same process I took without ever losing a dollar trading. I hope it makes sense. Thanks for listening to me. Maybe make that excessively clear. And until next time, stay sharp.